Hey there, Chris Middleton here with the Make Taxes Fair team, and we're here today to talk about the S Corporation and why that's such a popular choice when it comes to many business owners saying, "Hey, I want that as my tax strategy." And so I'm live and unscripted, just here to carry on a conversation, so to speak, with you. But want to show you this, some slides that we created to visually help explain this. And this is part of our what we call our Launchpad series, which is meant to be a DIY kind of guide to give you an educational foundation around different tax topics. So today, again, we're diving into how and why the S Corporation is a powerful tax savings vehicle. Well, to start with that, we really need to understand what motivates a lot of folks to get there with S-Corp. And probably the largest driving factor is what we would call the self-employed or self-employment tax bite. And what that means is for every dollar of net profit in your company, if you've been a sole proprietor or if you're an LLC, because sole proprietors, LLCs, single member LLCs are all taxed the same. For every dollar of net profit that you have, 12.4 cents goes to Social Security Medicare, 2.9% cents goes to Medicare for the self-employment tax. So kind of to view that a different way, for every dollar of net profit, 15.3% goes to self-employment tax, leaving you with 84.7% of every dollar. And that's before your income tax even enters into the picture. So anybody that's ever been self-employed that had a profitable year as a sole proprietor or an LLC has been like, holy cow, I owe what? Because that self-employment tax stacks on top of your income tax, right? That can get ugly. And so to kind of illustrate that a little bit more, if you were a sole proprietor, to kind of follow the money, if you had $200,000 in net profit, and this is a sole proprietor, LLC, single member LLC, if you show as one of those LLC or partnership shareholders, 200,000 in net profit, all of that is treated as self-employment income, and the self-employment tax alone would be just north of 28 grand. If compared to an S corporation, same profit, right? We don't change the profit, but $200,000 in net profit. Now we split that income. In part, you take a W-2 wage. We're saying in this case, $80,000 is a W-2. You pay that FICA, the payroll taxes, which is Social Security, Medicare, would be about 12 grand, a little over 12 grand. And then the balance of your 200,000 net profit would be $120,000 draw. But that draw or owner distribution is exempt from that Social Security Medicare. So in this instance, savings would be just over $16,000 per year, right? So that's kind of the draw. If you look at a self-employment tax versus sole proprietor for self-employment tax versus S corporation and what's subject to tax when it comes to an S corporation. So you can see, as your income increases, the earning potential increases. Now, this table, admittedly, is actually a little bit flawed because the Social Security, there's a cap on Social Security wages. So when you get up to that $200,000 and $300,000, it would actually be a little bit less than that. But the bottom line is your self-employment tax is exempt when you are a S corporation taking an owner draw. So one of the big things is then, what the reasonable compensation. So one of the requirements when it comes to an S corporation is you pay yourself a reasonable salary or reasonable compensation. So what does that even mean? Well, let's say we have $500,000 of gross earnings and expenses of $300,000. So there's that $200,000 profit as an S corp. Well, that $200,000 is exempt from Social Security Medicare. So Uncle Sam says, hey, wait a second. I want to secure, I want Social Security funding, right? They want to be able to support those that are receiving Social Security Medicare. And so that's what generates the reasonable compensation requirement. So again, I'm using an example of W-2 wage being 80 grand. And S Corp profit or distribution would be $120,000. By no in no way, shape, or form am I saying that on $200,000 net profit is $80,000 a reasonable wage. These are for illustration purposes only. So what does determine a reasonable or defensible salary? Well, training and experience. What skill level does that role require? Duties and responsibilities. What work is actually being performed by the individual? Time devoted to the business. Are they full-time operator, part-time owner? Comparable salaries, like what are the comparable salaries in your industry and market? What would the market pay someone to perform this role or these roles? The big business complexity, revenue, staff, risk, and decision-making load that's on that person. And then compensation history. How has pay changed as the company grew? Setting a salary too low can definitely trigger the IRS to reclassify, if you're an S corporation, paying yourself W-2 wage that's much too low. They can reclassify your owner draws and say, hey, there's penalties and interest. And so the classic example I like to give is I had a case where there's an attorney, and he was paying himself about 30 grand a year, and his business, he was crushing it, making almost I think it was almost $900,000 a year. And I told him, I said, Steve, hey, in what reality can you even hire a paralegal at 30 grand a year? You can't. That's not reasonable even for a paralegal. So for a full-fledged attorney that's a managing partner of this firm, no way. Like, that's not going to fly. On the other side, I had a owner operator, had a small company, about 20 employees. He was paying himself as a CEO, which he was a CEO of the company, but 20 employees. He knew everybody's names. He knew their kids' names. He was more of an owner operator than a true CEO. And he was paying himself north of $300,000 a year. So for the lawyer, who was paying himself 30 grand a year, we increased his salary, probably, I think it was about from 30 grand a year to about $180,000 a year. So he didn't see much in way of self-employment tax savings, right? He paid more payroll taxes on his W-2 wage. But for the owner of the consulting company that had 20 employees, we were able to drop his wages significantly, down to about 120 grand. So significantly saved him money on payroll taxes. So the bottom line is, an S corporation can be a powerful tax savings vehicle, but so many people jump into an S corporation without the consideration of what are they making the right decision. And this last kind of slide, we want to illustrate, when are some good moves, or when is it the right time to consider S corporation status? So you're a good candidate for an S corporation when your profits are consistently above the $70,000 to $80,000 mark. That's it. If you're a solopreneur making more than 70, 80 grand a year, that's when we can start kind of saying, okay, you have some revenue potential there to start paying yourself a reasonable salary as you grow in your role. An active owner with a clear role in the business is a good candidate to be an S corporation. Having clean books to understand, okay, here's how profitable our business is and where the money's going. Being willing to run payroll for the owner, because you can absolutely be a sole proprietor or an LLC and have payroll being run for employees, but you should not be paying yourself as a W-2 employee if you are an LLC or a single member LLC. The IRS does not want you to do that. They want you to take your income as an owner draw. And then the last thing is, you really need to be kind of ready for the S corporation compliance. And that's one of the things that we look at with folks and say, okay, do the tax savings exceed the compliance costs? Because you have to run payroll. You need to make sure that you cover those administrative costs for legal compliance. Bookkeeping, you really need to have clean books. Those are some of the administrative costs that you should consider when saying, okay, am I going to save more in taxes potentially than not by running my S corporation the right way? You should not consider an S corporation if you have low, inconsistent profits or are posting losses in your business. There are basis limitations when it comes to S corporations. That's just not a good idea. You should get to the point where you have consistent profits and sustainability. If the owner's role is unclear, you don't have clarity on who you are in the business and what the business, how you're actively engaged in the business. That can be not a good fit for an S corporation. And then if you're mixing personal and business funds, S corporation requires a clear, corporations in general require a clear delineation between personal and business. Some other things to consider when it comes to S corporations are, how many owners do you have? Is there more than one owner, and can you sustain payroll for more than one owner if they're actively engaged? And another consideration is, if you're a business that is an active income business. So I have an example where there's a gentleman that we're working with right now. He owns a self-storage unit, very large, about 300 units, and we're actually splitting the self-storage away from the LLC, or keeping the LLC in the property in the LLC, but we're actually splitting away the management activity, I should say. So the management activity is being split off into a S corporation that will be a property management company, because not only will he and his wife and his two employees be managing the self-storage facility, they'll also be managing both his own properties and other people's properties, as well as they grow their real estate portfolio. So S corporations are really optimal for active income businesses, where you are not producing passive income such as rents or capital gains and dividends and that type of thing. So that's kind of a high level overview about what an S corporation is, how and why it is a popular choice when it comes to business entity legal structure, right, for business owners. Again, if you're watching this maybe on our YouTube channel, or found this somehow, this is part of our kind of launch pad series of what we have with Make Taxes Fair. And again, I'm live and unscripted, so I got the ums and the ahs and the oohs, but this is designed to help kind of give you a high level overview of these concepts. In earlier sessions, we talked about entity mapping and creating a visual map for your business entities. And in future sessions, we're going to talk about more in depth around reasonable compensation, and then other strategies that fit into S corporations and LLCs and that type of thing. So if you're here and you've enjoyed this, thank you so much for being here. We hope this is helpful, and the tools that go along with this. We invite you to actively participate in going through those and seeing if you are indeed the right candidate for an S Corp. If you are already an S corporation, that can help you kind of tune up and say, okay, what am I doing that I not doing that I should be doing to maintain my S corporation? So if you, again, are seeing this on YouTube, or this was shared with you from a friend, we like to say friends don't let friends overpay the government. So if you've enjoyed this and you want to get more like this, check out our tax strategy community at maketaxesfair.com/community. And thank you for being here. We hope you enjoyed this and this was helpful, and we'll see you in the next round. Bye for now.